the focus is going to remain on what's happening in the auto space. Remember, we've been talking about the underperformance of the auto space on a one-year basis and how most of these stocks have seen a year-over-year decline, not just stock prices, but you've seen a dwindling festive season weighing down in terms of the high inventory build-up for most of the auto dealers as well, and whether or not that has a significant impact on the kind of new orders that they place with companies because of the inventory pile-up, and that in turn affects volume. Let's find out all of that and more with Ankit Merchant. He's the auto analyst at SMC Institutional Equities. Ankit, thanks very much for taking out the time. Lots been happening in this space. We've been talking to various, dealers and the Auto Dealers Association, which is very concerned about the fact that this time's festive season was not up to the mark. They're sitting on a huge inventory pile-up, which they're actually not seeing going away anytime soon in a meaningful way, which in turn could affect their new orders with companies and then could affect volume growth, which so far, has been just at par. What's your reading of the situation?
Yeah, good afternoon, Devina. So, what we understand is basically there have been four factors which have been played out, and which all of these four factors played out at a similar time. So, first factor is, as we know, is rising fuel prices. That has been the major, concern for an urban commuter, basically one who's been traveling approx 100 kilometers every day, and the incremental cost because of the fuel price hikes has been very large for this particular market, has been for the urban players and for the urban customers. Coming to the rural, as what we understand is basically the MSP prices, as we know, will take time to come in. So over there also, from their point of view, the demand for the automobile haven't turned up till yet. Second, as we understand, is the insurance cost, and insurance cost we know is that has gone up substantially. For the two-wheelers, it's now mandatory to have 5 years of insurance, and the incremental cost is in the range of 7,800. So suppose I'm a new buyer today, if I want to buy a new motorcycle today, my incremental cost is likely to be near about 7,000 rupees. So that's one point. And coming to the passenger vehicles, the incremental cost for a 1500cc engine has gone up to 24,000 rupees. So that's the upfront cost which has gone up substantially. Third is what we understand is the competitive pressure amongst the OEMs. Now, as we understand, the pie has shrinked, and for every particular slot, everyone is fighting and everyone is going full to get that extra margin, to get the extra particular market share. They have been fighting a lot. We have seen this for the two-wheeler space, and the last one is basically the liquidity crisis which happened. So what has that done is basically the new buyers which were supposed to buy are actually thinking that right now the interest cost has gone up, my insurance cost has gone up, the fuel prices are also very again high. So why should I buy it right now? So what I understand from my particular analysis is that will take some time to recover from this particular events which has happened. Yes, the crude prices have come down recently. And what we also understand, the dealer inventory is also again very high. That will take time to flush out. So what we understand is from January onwards, we could see some fresh buying happening. We could see the dealer inventory moving much faster, and then in fact we will see the automobile numbers coming in very strong. So that's my reading from the current scenario.
Right. Ankit, good afternoon. This is Agam. Then my question is, if I were to dissect the entire sector, and let's start by talking about your four-wheelers, the passenger vehicle players especially, which of these names do you expect to do relatively better? I understand that you're not expecting a significant uptick given the terms and conditions that you've spoken about, but which names do you think could do better, and which names are at a significant disadvantage given the current conditions?
So we particularly like Maruti Suzuki. One reason has been we clearly understand it's a market leader. 53% of the market share is with them. Yes, there has been some basis points lost of the market share, and that has been gone to the Hyundai. But all we understand is, see, as soon as the revival will be happening, the Maruti Suzuki is likely to be the key beneficiary. You name it in any particular segment, be it Mini, be it their sedan or be it their UVs, they all have very good demand. In fact, still till today, Baleno and Brezza has been having a waiting period. Except you take out Baleno and Brezza out of the industry, you tell me there are no other vehicles which are having a long waiting period. So that's one particular advantage which company has been having. Yes, but because of Brezza, again, because of the high waiting period, what has also happened that some of the Brezza buyers have now gone into buying Nexon or be it some other SUVs in that particular space. But still, there has been a the core premium which Maruti Suzuki enjoys in the eyes of the in the eyes of the consumers is really what attracts us. And one more supporting point has been the valuation. Company has been down from approx 10,000 levels, which it used to trade. You're getting a similar story, which was 6 months back. We were playing the same particular story. Yes, in the interim, there has been demand has come down. The numbers have been not been that great, but partly the numbers are also been impacted by the export numbers. I was just looking at the export numbers from April till date. The numbers have been declining like 10%, and that's a really a big number. The second most the second most line item which has declined for Maruti Suzuki has been the mini segment. Now, mini segment has been down close to 6.5% from April till date. The major reason for this particular has been the Ola and the Ubers, where there is not much of addition of the new drivers which have been happening, which has led to some bit of demand. And the new buyer, as we understand, the new buyer is more keen towards buying the entry level segment more, and the insurance cost and the other cost which has gone up has basically led to demand being extended or demand which has been delayed, which will surely come back post January onwards. In fact, I won't be shocked that December numbers, in fact from the December numbers, because of the sale, we could see major amount of dealers inventory getting flushed out because of the December discounts which happens every year. So Maruti is one particular pick in the four-wheeler space. Moving on, we particularly like Bajaj Auto as well. Bajaj Auto, as we understand, has been gaining market share. There have been twin factors over there. One is the domestic performance. Second has been their exports. They have been doing really well in their export segment also. Yes, the stock has been beaten down because of the margin guidance. But again, what I understand, the realizations from quarter one of FY20 will be at 71 rupees for their exports, which will compensate for the margins which have been getting lost right now. So, structurally, if anyone or a long-term player who is keen to investing into the automobile space, I think at this particular juncture, Bajaj Auto as well as Maruti Suzuki provides a good opportunity. Now, coming to CV as a segment, we believe the liquidity crisis is going to hit mostly to the CV players. What we'll see is that over the next 2 months, specifically, the CV demand or for MHCV specifically will be coming down a lot, but which will be again compensated by the LCV sales. Now, rural demand will start kicking in from January onwards because of the harvest season, and we can see some bit of revival coming in from there. Another major factor which is likely the market is right now missing out is basically the transition to BS6, and a lot of pre-em buying will start. So April onwards, we'll see a lot of pre-buying which will start coming in every day for MHCV and LCVs. So in that particular space, we like Ashok Leyland. The stock has been down 60% from its peak, and at this particular juncture, it provides a lot of comfort for us to enter into the stock. Yes, there have been issues. Basically, the Vinod Dasari has resigned, but he's still there till March, and we remain confident. It's such a big company, and it is run by a professional. So we continue to like Ashok Leyland and from this particular levels also.
Okay, so that's Bajaj Auto, that's Ashok Leyland, and that's Maruti that you like. I'm probably going to move out a little bit, so zoom out a bit and talk about the peripherals as well. So the auto ancillary pocket tire companies now gain center stage as well because of what crude oil has been doing. So the likes of a Seat and Apollo tires, whether or not you actually see some improved traction within the auto pack, within the auto ancillary pack, and within the tire companies in particular, and whether you like anything there.
Yeah. So in tire space, what we understand is One, there has been severe cost pressure because of the crude oil prices. Second has been the natural rubber prices, but what we understand that has come down over the last 1 month, and the crude also has come down. But the real benefit they'll start achieving is when the OEM will pay the price for them, and which is very unlikely at this particular juncture. So tire stakes, we remain a little bit cautious, and we will enter at levels where we will find more comfort. However, that said, C8 is what we like at this particular juncture. But again, valuation is where we'll like to see. Stock has gone up substantially from it was at 1,000 levels. Now it has been trading at close to 1,200. So that's really it has appreciated a lot over the last 15-20 days. But we'll look out for more players in that particular segment in tires, and where valuation gives us more comfort. Moving to the other auto ancillary, again, most of these auto ancillary companies are going to face issues with the cost, because OEMs are not taking that particular cost right now, because OEM itself have been battling with their own particular cost. So any price hike by the auto ancillaries as such to the OEMs is very unlikely. So margins are about to shrink for the auto ancillaries in this particular market. But however, there have been companies in this particular space which we really like. One is Talbros Auto. That's one particular company which has stood out from the other auto ancillary segment, where the margins quarter-over-quarter as well as year-over-year has gone up, and that is purely on the basis of the cost restructuring which they have done. So Talbros Automotive, we are very much positive on that particular company. Again, a very small company, but you look at the growth prospects of that particular company has been phenomenal. Again, has a very well diversified clients, has exports, is equally present into the domestic, and is a market leader when it comes to making gaskets, have close to 40% market share when it comes to making gaskets. So that's one particular company which we really like, and we continue to be positive on Talbros Automotive.
Okay, Ankit, we'll leave it at that. So thank you so much for joining us and taking us through your views and how you read these variables in the auto industry.